Hi, everybody. This is Ken Weber, president of Weber Asset Management here in New York. Today is January 27th, 2021. This is our first video chat of the year. I'm joined by our chief investment strategist, Jack Bowers in Nevada. And we have a lot to cover. 2021, 27 days of the year have not been uneventful. The understatement of the year. Jack, we have so much to cover, but since it was covered on CNBC, the first thing this morning is some incredible news about Reddit and stock manipulation, just crazy things going on in the market, with a number of stocks going up 100 or 200% today, one day, having nothing to do with the valuation of the stocks. What's going on there? Give us a brief overview of what's happening.
Well, for a long time, ever since they eliminated the uptick rule, the short sellers have really had kind of free reign and not a lot of things to keep them in check. And some have even worked together to try and target stocks where investors were too optimistic.
It seems a lot of working together, actually, right? That's like a thing.
Yeah, and there's no denying that they held the price of Tesla artificially low for probably a 5-year period. I think that was where the showdown first occurred. Tesla ended up with enough car owner investors that the short sellers got outnumbered, and there were more optimists than pessimists, and the shorts got overwhelmed last year, and they ended up running for cover, and we had this major squeeze that drove up the price of Tesla probably too far, actually. But now a lot of these millennial investors on Robinhood and other apps working together to target the shorts. So the tables have been totally turned around on them. They're looking for stocks where the shorts are really bearish and have open positions, and they're getting in there and buying. I'm not sure GameStop is, worth its price at this point, but to some degrees, this is strategy. Just trying to make a short-term gain the way the shorts were trying to do when they drove down prices. So, it's just kind of
the bottom line is: do our clients, do individual investors need to be concerned with any of this?
Well, there are some signs that we're kind of back in the year 2000 again. I'm not overly concerned about that because the really high valuations these days seem to be reserved more for companies that are profitable. And that was not the case back in the year 2000. But there are, increasing number of examples where there are excessive things going on, and they are pretty narrowly confined to certain stocks where there's things going on. So some of the Tesla's competitors have formed these blank check companies, and investors have bid those up really high without any of these companies being in production. So it's a situation where there are some excesses and prices are definitely high, but at the same time, we have this situation where most pessimists got out of the market last March, and they're still sitting largely in cash. And so the market is kind of ruled by optimists now. And there's nothing really holding the prices in check the way there normally is.
So the market volatility that's happening today, January 27th, and may happen the next several days, does not affect our long-term investor clients.
No, I think if you're a diversified investor where you've got hundreds of stock positions, most of the crazy things are happening in just a handful of stocks. Right. And, it's really kind of strategy that has nothing to do with fundamentals. And we'll probably see more of it. This is kind of a new age and a new group of investors, and things play out this way.
It's the kind of thing, to my friends watching, that you couldn't have predicted a couple of years ago. I mean, there's always something new under the sun. Hate cliches, but that's the fact. And so I was watching CNBC just earlier, and there was one pro guy and one host, and they were really going at it. The host on CNBC says, well, you might be hurting investors. But the thing is, they didn't expect it. The CNBC experts didn't expect it. And so a year from now, there'll be something new. So when clients ask you or me, well, what's ahead for the market? We don't know. We just have long-term horizons. We can make educated guesses about whether it's better to be in value or growth in the next 6 months or 12 months. But in terms of day-to-day fluctuation, it's just a guessing game because there's always something.
I do think there's probably a bit of an earnings catch-up period that we're going to be going through where earnings grow faster than stock prices. So, and it should be expected that stocks may lag their traditional 7 percentage points above the rate of inflation return that we typically see over.
Well, that would be reverting to mean
years.
anyway, right? Be reverting to mean we've had like 11 or 12 years of a general up market. So
yeah,
we might be overdue for a slowdown at some point.
Yeah, unlike the year 2000, we don't have a whole bunch of tech companies that are facing an earnings drought. Because what happened is there was a lot of spending for Y2K, and then afterward it all dried up. And so it was kind of a double whammy, and a lot of tech stocks lost 85% of their value. In fact, the whole tech sector was kind of in that camp. And I don't, it's certainly reasonable to expect that tech stocks and large cap growth will underperform this year, because if we get a cyclical recovery, there will be a lot of rotation out of high price stocks into low price stocks. But I don't think we're in for anything like what we saw back in 2001 through 2003.
I agree. But in terms of earnings, before we came on today, I saw a report that Apple may have earned, this is a projection, before it's officially announced, but they may have earned $100 billion last quarter.
Mm-hmm. Yeah, the tech disruptors, take a lot of money to get to scale, but once they get to scale above a certain point, they become very profitable, and that's true for Apple. It's true for all the other FANGs. It's true for Tesla. So
let's just say what FANGs are for those who are not familiar.
Facebook, Apple,
Netflix.
Netflix, and
Google,
Amazon,
and which is FAANG, and G is Google, which is actually Alphabet. But yeah, we understand it's the tech sector that's disrupting.
Yeah, I think if there was a way to add NVIDIA and Tesla into that acronym, that'd be nice to do. But I don't know.
By the way, full disclosure, two Tesla drivers right here. Yeah, and one heavy stock ownership of Tesla. I just ride around in my Model X. Yeah.
The other day I was looking at the price for Tesla, which is kind of unreal, and I realized it could lose 95% of its value, and it would be something like, "Oh no, we're back where we were 16 months ago."
Interesting. Before we turned on the recording, you said to me you think Tesla, for those of you who still own the stock, that you say it might now be overvalued?
Oh yeah, the pricing is for kind of 2030 expectations, when Tesla might be the world's largest automaker, maybe with 20% share of all the electric sales.
Right.
And that, they certainly got all the pieces to put into place, but it hasn't happened yet. And lots can happen between now and then, and
including competition.
Yeah. It's the Lucid is probably Tesla's most viable competitor at this point. It's a Bay Area company that's starting up with a new model.
Yep.
But they've got some Chinese competitors that are trying harder now that Tesla's in their market.
And Audi and BMW, they're all coming out with EVs.
Yeah, they're kind of using off-the-shelf parts, so they've got a lot of work to do on efficiency, and none of them have a good charging network. But you can be sure there will be a lot of investment in the decade ahead. Good.
Now, speaking of high growth, I do want to touch on the value versus growth tension that's always out there. We talked the last time, I think, that we're on this video, leaning towards the value sector, moving slightly away from growth. So we're many weeks from that last discussion. Anything change in your outlook for that?
Well, we've moved the portfolios late last year so that they're in a position where we're kind of straddling the fence. We're roughly half in value and still roughly half in the large cap growth segment. Right. And I think given the uncertainty of how much this rotation will occur and when it will occur, I think that's a reasonable way to play it at this point, because we don't know how quickly, on a global standpoint, the vaccine rollout will occur. And while the vaccines themselves are likely to work really well, it's not clear how quickly some segments of the economy will bounce back. Airlines and travel, those things could have kind of a long recovery cycle. And then there's some segments like energy that may not come back to what they were. We've got a lot of issues there. And we're kind of 5 years in the future at this point in time, not only with, web-based things, but in terms of energy and renewable sources picking up speed, and electrification of transportation. These things have all sped up as a result of the pandemic. So it's really hard to know how it'll play out. I think the large cap growth segment is on fire with earnings, and that will continue to be the case, but the valuations already reflect that now. And so really the smart rotation will be into value stocks as the economy takes hold. We're just kind of waiting for that, and the way we're positioned right now with kind of straddling the fence, I think we'll be able to move more aggressively into value when the time is right. But for right now, we're in a position, I think, that's comfortable given all the uncertainty of what might play out.
Right. I'm actually a little more optimistic now about the vaccine rollout. I think we might be 2 or 3 weeks away from Johnson & Johnson getting the emergency authorization for the one-shot dose. Biden says he's going to start the Defense Production Act, which should speed things up a bit. So I think by summer, we're going to look pretty good. Clearly, getting a massive logistic problem like getting the U.S. Population vaccinated in a relatively short amount of time. Clearly some rocky days and weeks. But I think even 3-4 weeks from today, things will start to get
for all the fits and starts, things are actually moving along pretty quickly.
A million a day. We're already there.
Israel, I think, has got 30% of their population vaccinated. The UK is around 10%, and the US will probably be there in a week or two. So
I got my first shot.
Oh, okay, great.
My second one is February 7th. Looking forward to that. Then I can finally get on a plane. Haven't had a vacation day for my clients in a year.
Oh, okay.
Take care of you guys.
Yeah. Well, I've been on a plane all along, but
it'll be
a little more comfortable once you're vaccinated. So
yeah, exactly. So I just want to touch on the political situation. We're just, very short time removed from the inauguration. We actually have some clients who, say if Republicans get in, I'm out of the market, and vice versa. And to the point that some clients said, if Biden gets in, I'm getting everything out of the market because we're going to become Cuba or something like that. You and I have somewhat different political views, but we agree on one thing. The person in the White House really does not have very much effect on the stock market. Go ahead.
Yeah, the market really doesn't care who's president.
Right.
That's basically what's going on right now. And, the market does prefer a balance of power in Congress. While the Democrats are technically in control, the rules and procedures still are going to require probably about 10 Republican votes on any major legislation that gets through Congress. And for that reason, it can't all be one-sided. And I think that's what the market likes to see. It kind of precludes any really hostile tax legislation or anti-business legislation, and at the same time may keep things balanced in terms of how much of our stimulus programs roll out. And I think the market likes to see that. And so we're that's why the market hasn't reacted much to this, even though we hear a lot from individual investors about how they don't want to be in the market because this person is running the country. I mean, that's a little childish, to put it bluntly. Those strategies have never worked in the past, and they aren't working now. If you're a long-term investor, you can't act like a farmer who decides one year they'll water the crops and then another year they won't. You got to pretty much farm every year, and that's a mature approach, and that's the long-term approach.
Well said. And again, we were talking earlier. I think we both agree, more important than the White House occupant is who is sitting in the chair as chair of the Federal Reserve, because that's the person, along with the whole Fed, who sets interest rates and other fiscal monetary policy, where they have much more of a hands-on affect to the economy than the White House.
Yeah, it's been amazing because you look back how the Fed handled the Great Depression and what they did with the pandemic was 180. They totally learned all the lessons of the things they did wrong back then, and they didn't waste any time doing everything right this time. So,
Right, right.
you know, it's
Yeah.
like they moved even faster than the financial crisis, which they kind of dragged their feet on.
Right, right.
So as a result, you know, we've largely achieved the goal of, you know, pushing off avoidable bankruptcy and allowing lifelines for businesses to be out there. And as a result, we are in position to recover now that the vaccines are here. So it's really, it's been, the Fed has really been in the driver's seat on this, and it really has worked well, I think.
And for my political friends, I'll just point out, Obama appointed the chairman is Jerome Powell, Jay Powell. He was appointed to the Fed by Obama, and Trump made him chairman of the Federal Reserve. So both sides are represented in that one person, Jerome Powell. And Jack and I agree that he and the Fed have done a very good job of steadying the economy. And there will be ups and downs. There'll be a downturn out there, you know, next week or a month from now. But in general, again, I'm sorry for belaboring the point, but it's not the president who's affecting the stock market. The president can affect the economy, but often the economy and the stock market are going separate ways. By the way, if the economy starts to heat up and start doing really well, well, then the stock market will say, the Fed might raise interest rates. And at that point, people will pull out of stocks. If the economy is doing well, that's a great irony of stock market versus economy. You know, there's an old expression, when interest rates are low, stocks will grow. So if the economy heats up and interest rates start to go up because the Fed is worried about inflation, then we have a whole other set of issues to think about and worry about.
Yeah. Yeah. I think to the degree that the yield curve steepens, that's actually bullish for stocks and for high yield bonds to some degree.
Right.
But I do think we will see this in the value side. We will not see it in the growth side.
So you mentioned bonds. We've had a few clients ask us about bonds and the interest rate environment. Spend a minute or two talking about that.
Sure. I think what we have right now is, you know, short-term interest rates held near zero, and the long-term interest rates also very low. Even though the Fed doesn't directly control those, they have done some things to help there. And oftentimes the long end of the curve is set globally, and interest rates in some other major regions like Europe and Japan are actually negative. So that's helping to hold down the long end of the curve as well. But I do think if the economy bounces back strongly, we are going to see the long end go up. The Fed has said they'll hold the short end down, you know, at least till 2023, maybe longer, and live with extra inflation if it happens. So I think the smart way to play bonds right now is to go with high quality funds that have very short durations, and then also include along with that some corporate exposure, preferably high yield if the risk can bear high yield in the portfolio. And I think the combination of those two gives you kind of a decent income stream with very low interest rate risk. And then you also have to keep in mind that stocks and bonds are generally inversely correlated to some degree, or very low correlation. So the whole reason in blended portfolios that we hold stocks and bonds together is because they don't always move the same way at the same time.
Absolutely.
So it would not be surprising to me if we don't make a lot in our bond positions in 21, but we do okay on the stock side.
Right.
But that's kind of by design if that happens.
Absolutely. And I'm often explaining that to especially newer clients. The bonds are there not to make you rich, but to balance off the risk. You know, last couple of years, you actually have done a great job, Jack, picking the right bond funds at the right time. But it's not like we're going to make anybody rich from bond funds, but to have a diversified portfolio that will get you through various market scenarios. That's how we use bond funds.
Yeah, there are admittedly no great ways to win with bonds next few years, but there are some tricks you can do. And in some portfolios, we have mortgage securities, which is actually negatively correlated with stocks. And when we run the risk numbers on the portfolio, that allows us to be a little more aggressive on the stock side than we might normally be. Right. And that itself can work out, because a lot of the value stocks are higher volatility. And so this allows us to take on more value at a time where it might help. So we're just trying to make the entire portfolio play in a way that makes the most sense right now.
We're wrapping up the amount of time I've allotted for this, and this is our first chat, as I said, of 2021. And I don't want to make you blush or anything, Jack Bowers, but your numbers for 2020 were outstanding. We're not allowed to guarantee past performances, no guarantee of the future, but knock on wood, you had an extraordinary year with your mutual funds selections for our clients, and congratulations.
Yeah, a lot of that was positioning at the beginning of the year, because I've been bullish on tech disruptors. And I believe we're entering a period where kind of the tech disruption is intensifying, and it may be a theme in the markets for, you know, the next couple decades. So a lot of our portfolios were very large cap growth oriented. So when the pandemic hit, that turned out to be the right place to be. So
And we had a number of
I can't take all the
portfolios.
credit because I didn't foresee the pandemic, but at least the tech disruption play worked. And now the tricky thing is trying to exit that gracefully in a way that you know, we continue outperforming if we can.
If we can, no guarantees.
Yeah.
But last year was great. Long-term performance has been quite good, as our clients know who have been with us for a long time. So I thank you for the work you've done on the behalf of Weber Asset Management and our clients. We're always trying to do the best we can for you guys.
Yeah, and we also have to thank all the Fidelity managers. It's a year where there were a lot of winners and losers, and suddenly spending money on research is paying off big. So
I'm glad you got that in there, because there's always that big push. Well, what about index funds and ETFs, passive management? Jack Bowers is a big believer in active management. You get the best and brightest people to watch the stock market through a microscope. They won't always be right. But as Jack has just pointed out, last year was an example where they were right. They did make the right choices. Yeah. Good, Jack. Good talking to you. Happy New Year. You went skiing, you hurt your shoulder. Hope that ends.
I'm getting physical therapy from snow removal now.
All right. Okay, Jack, thank you very much. And if it's not too late, Happy New Year to everybody out there. And we'll see you next time. Thank you.